Have we finally reached the singularity? Elon Musk seems to think so, defining it as the moment artificial intelligence advances so rapidly that our forecasting models simply break down. And looking at the data crossing my desk this morning, specifically regarding the explosion of AI agents, it is hard to argue against him. We are seeing a divergence that terrifyingly few people are paying attention to. While the majority of the market is distracted by short-term noise, a quiet revolution is happening in the background that is poised to reshape $30 trillion of global commerce. I'm not talking about simple chatbots or image generators anymore. I'm talking about autonomous economic actors, agents that own their identity, pay for their own resources, and transact without human permission. But here's the catch. While the fundamental narrative is screaming up only, the price action on some of these assets requires nerves of steel. We are sitting at a historic intersection between a massive technological breakout and critical technical support levels. If you are holding tokens like Fetch.ai or watching the recovery in Render, you need to understand the structural shift that happened on the charts this week. We are going to look at the undeniable proof that the agent economy is the only viable path forward for the internet. But more importantly, I'm going to show you why the technicals on my chart, specifically the weekly closes, suggest that 2026 might be the year where generational wealth is either made or lost, depending on how you position yourself right now. Let's zoom out for a second and look at the macro picture. There's a chart from Discover Crypto that I have been staring, and quite frankly, it's one of the most sobering visuals I have seen in years. It plots the S&P 500 against total job openings. For 2 decades, these lines moved together. When the economy was good, stocks went up and jobs went up. Simple. But look at what happened after the launch of ChatGPT. The correlation broke. The S&P 500 continued its parabolic ascent, ripping to new all-time highs, while job openings plummeted. This is the adapt or die moment. The market is pricing in a future where corporate efficiency skyrockets due to AI, while traditional human labor demand softens. If you are betting on the old economy, you are fighting a losing battle. This is why we are seeing such aggressive rotation into the AI sector. Just look at the sector performance for the first week of 2026. According to Income Sharks, AI and memes are the only 2 sectors showing significant relative strength, completely decoupling from Layer 1s and DeFi. The market is telling us exactly where the liquidity is flowing. It's flowing into attention, and it is flowing into intelligence. However, recognizing the trend is only step 1. Step 2 is understanding that not all AI tokens are created equal. We are transitioning from the hype phase into the execution phase. The projects that can actually facilitate this new machine-to-machine economy are the ones that will capture that value gap. And that brings us to the fundamentals, because the news we got this week changes everything for my portfolio thesis. We need to talk about the infrastructure that allows these AI agents to actually exist. Andreessen Horowitz, or A16Z, put out a framework that perfectly articulates the problem. Artificial intelligence has 3 massive holes in its armor right now: identity, payments, and provenance. How do you know an AI is who it says it is? How does an AI pay for things? And how do we track what it creates? Crypto is the missing puzzle piece. It provides the proof of human systems, the decentralized payment rails, and the immutable ledgers for intellectual property. They estimate that by 2030, $30 trillion in purchases will be made or influenced by AI agents. That is the number you need to tattoo on your brain: 30 trillion. This isn't theoretical anymore. Fetch.ai has officially launched the world's first agent-to-agent payment system. This is a massive milestone for my portfolio holding. We are talking about personal AIs executing real-world transactions, booking flights, paying for API access, hiring other agents, completely autonomously. This moves Fetch from a speculative asset to a utility necessity in this new economy. And it is not just Fetch. The entire ecosystem is heating up. We saw huge news from Virtual's protocol regarding their 2026 roadmap, revealing their agentic commerce protocol. They are targeting 500,000 real-world tasks completed. They are building the rails for micropayments in this new economy. We are also seeing institutional validation that we simply did not have last cycle. Grayscale filed for a Bittensor ETF, and Bitwise filed for a multi-token strategy ETF that includes exposure to Near protocol and the AI infrastructure stack. When you have the suits filing paperwork with the SEC to buy these assets, you know the smart money is positioning for a breakout. Even the developer landscape is shifting. There is a new standard called ERC 8004, highlighted by Delphi Digital. It's a registry system for AI agents, allowing them to stake Ethereum to prove their honesty. If an agent lies or delivers bad output, their stake gets slashed. This brings economic consequences to AI, creating a trust layer that simply didn't exist before. And I have to mention AIXBT, another key holding in my portfolio. As we see more proprietary financial models and on-chain analysis agents coming online, tokens that facilitate this specific niche of AI that understands markets are going to be incredibly high beta plays. The groundwork is laid. The institutions are here. The tech is working. Now, let's see if the charts agree with the bullish fundamentals. I have pulled up the weekly timeframes for all my 5 key assets, and the structures are painting a very specific story. First, let's take a look at Fetch.ai. Take a look at the last 3 weekly candles. We are up about 60% from the lows. More importantly, see where the price bounced, at the support of the falling wedge. We are sitting right in the green accumulation zone that I have marked. If the 20-cent level holds, my first conservative target is the 236 Fibonacci level, which sits at 60 cents. That's 100% increase just to reach the first level of resistance. Now, flip over to Virtual's protocol. This chart shows a different kind of strength. Unlike Fetch, which is at the bottom, Virtual's is in a recovery phase. See that orange dotted trend line acting as support? We just printed a strong green candle right off of it. The next major resistance is the previous high structure around $1.90. If the agentic commerce narrative catches fire, we have clear air above that. This chart tells me the bulls are stepping back in. Next, let's look at Render. This is the standout chart of the week, up over 90% from the bottom of this orange descending trend line, smashed through that $1.50 resistance. We are now above the 10-week moving average. If we can close a weekly candle above $4, Render is officially back in a bull trend. The momentum here is undeniable. Then there's the leader, TAO. Look at the structure. We had a massive correction, but we found support around the $210 mark. Currently, price is compressing between support and the resistance of the 10, 21, and 55 EMAs. The key level to watch here is $388. A break above that opens the door to the $600 region. TAO is the index for this sector. If this chart looks healthy, it gives permission for the rest of the sector to run. Finally, there's my high-risk play, AIXBT. The price just lost the 4-cent region once again and is rejecting the 10 EMA. Falling wedges tend to break upward, but perhaps more consolidation is expected. Losing this pattern would be concerning, but for now, it looks like the price is tightening in preparation for the next leg up. To summarize the technicals, Render is leading the breakout, Virtuals and TAO are recovering strength, and Fetch and AIXBT are at critical accumulation support levels. So, how do we play this moving forward into 2026? The strategy has to be a blend of aggressive positioning in the momentum winners and patient accumulation in the value plays. My outlook is centered on that $30 trillion figure A16Z mentioned. We are going to see a flight to utility. The projects that actually facilitate the agent-to-agent economy, the ones handling the payments, the compute, and the verification, are the ones that will stick around. I'm looking at Render's strength as a leading indicator. When the compute layer pumps, the application layer usually follows. This makes me very bullish on Fetch catching up. The gap between Render price action and Fetch price action is an inefficiency I'm willing to bet on. For Virtuals, I'm watching that $1 level closely. If we can turn this previous resistance into support, I'll be looking to add to my position for a run toward that $5 target implied by the fib levels in the long term. However, we must remain objective. If Bitcoin decides to roll over 80,000, these support levels mentioned are our invalidation points for short-term trades. In my opinion, the trend in AI is shifting from bearish to bullish, but we need those weekly closes to confirm. The signal is clear. The Singularity, it's already starting to bleed into the markets. We have the institutional ETFs filing. We have the technological breakthroughs in agent payments, and we have the macroeconomic pressure forcing adoption. The divergence between the stock market and the labor market is my warning sign. You can either ignore it and hope the old world comes back, or you can position yourself in the infrastructure that is building the new one. As always, none of this is financial advice. I'm just a guy reading the charts and trying to stay one step ahead of the machines. If you want to stay updated on my exact moves and see these charts the second I post them, make sure to join the free Telegram group. The link is right there in the pinned comment. And if you want to understand the deeper infrastructure plays I mentioned, check out my previous breakdown on TAO and Near Protocol right here. I'll see you in the next one.